Hey guys, what's up? We're gonna watch Jerome Powell speak at the Jackson Hole Symposium. You are welcome to join us if you're watching this and it doesn't say live. You are watching a recording. Pretty straightforward. I've got different tickers I'm looking at over here. This is GameStop I'm looking at, and then I've been looking at SPY, but Astra was taking a little rip here in the morning. We've got a rocket taking off today, I think, so got some positions on that too. What's up, chicken? I need to share this link. Share the link with people. Let me see. I don't. The thumbnail is a yacht. It's supposed to be something different. Okay. Yachts are cool. It's a silent yacht. All right, I'm gonna share this on the Twitter. Like how it's a yacht. That's an awesome thumbnail. What's up, chicken? What's up, Crystalline? James, Nicholas. I like money. Rocket point of the moon. I know it's kind of taking a little dump right now. GME. Powell's coming on in like 7.5 minutes. So I'm not an economist. I don't even know how to say that, but I still like to listen, try and learn. If you guys know what's going on, feel free to share in the chat. GME still looking good though this morning. It's kind of this MACD crossover bearish. Only thing I didn't like about it, but I'm kind of just equating that to a consolidating, and so it's settling down because it got really high up here. Because the price action is showing it's very nice bull flag. RSI is coming down, which is good. So it's setting up for another rally, I'd say. On the daily too, yeah, it's just getting poised for another rally. Could be today, could start next week. We'll see. Part of it might depend on what Powell says. I think kind of the short covering has moved over, or has been over at TCAT and or support, which is going in and out of halts right now. Let's see, it's still halted. I can't believe things at 36, so I have an option play on it, and I looked at it, and when I picked it up, it was a 9-10 put credit spread, and 10 was out of the money at that point. So I was just looking back where I picked it up back here, and I was like, the IV is so high, I can't go into this thing. Yeah, it's back here. I did a 9-10. I was like, all right, this is out of the money. This is aggressive, and it's at 36. It's just insane. So yeah, I think this is heavily shorted, and it's quite possible it's by some of the same people that are in GME on the wrong side of GME. So it's getting covered, as well as TCAT, and looks like Marin wants some today. Urban One sometimes runs in the same time. Saw Nautilus the other day. I don't know if this is part of it or not. Viri, I actually have Viri in the long term. Got that at IPO. Don't ask me why. Okay, so yeah, you've got GME here. Cool, you can see that. I don't have a schedule where I can live stream a whole lot, so I might be muted at times. Let me know if I'm going to put on some nice yaz to soften your ears, and I will do it. Pull us back to the 5-minute. So I borrow actually on GME. They borrowed like let's see, 60,000. They borrowed 60,000 shares today, just based on iBorrow's limited data. The fee's still really low, 0.6. But as long as we hold above this support, I think we'll be good, even with this MACD being bearish. This 195-ish support, and it's possible we come down and retest it. But so far, I mean, it hasn't even really done that. I thought yesterday it maybe could have on this big red candle. I thought we might come down further, but I think it's holding up strong. It's squeezing so much different than last time, or sneezing. What's up, CMA? we look at this chart's so skinny. If we look at back here, you could say it started down here, the rally, but really it started sneezing right here inside this window. This potential futures rollover period window. Here's the SPY. I'll leave this up too. So it's this time it ripped and then it, you know, consolidated but kept kind of climbing up. I guess we're kind of seeing that actually. Not as much positive price action, but now that I look at it, it's just less movement during the day. The open to close is less, so it's not moving up as much, but it has at a bigger range at this day, and this day is a little smaller, and maybe today will be even smaller range. I don't know. I feel like today we might get some action, but at any rate, it's a nice consolidation. It's maybe looking even more like January, like this. See this? Big huge day, and then just consolidated. 1, 2, 3, 4, 5, and then it rallied. Could be more like this. I actually saw right up on Reddit comparing it to this January, the January sneeze here, and he had a lot of different factors. He was bringing in data from all sorts of stuff to say how this is just like January. I can't remember all of it was, but price action so far actually would make it seem that way. I'd say more than the last two. I'll leave that like on the 5-minute just while I'm watching it. Then I'll zoom out, do the hourly, and just get an overall view. Express, yeah, Express too for sure. Is it getting covered today? 81.81%. Yeah, its chart looks pretty different from GME now, though. Look at this. It's just been on this upward trend since January. It's interesting how they've kind of cycled and are covering in different ways now. You know, different times, different velocities. I think they've kind of tried to spread them out a little bit. You know, so it's not just this this one massive cluster of stocks that go up. It's just more suspicious. Spirits unhalted or support. Thing's just been halted. Wow, it's holding up though. This thing's gonna keep rallying. Look at this. It's gonna keep going. Oh my gosh. I put in an order on my E-Trade on my play. It's not gonna close though, because I've got until September. That's the thing. They don't have any options. Any shorter dated options. So, I mean, holy crap, 1439 strike. Okay, finally those came up. I'm gonna show you guys the option chain on support. I was looking at it, I was like, could you even make that much money on this? And now you could. Now it's up 100%. That was a huge jump. So I was looking at like 14 strike. I mean, they just actually added these strikes, I think, didn't they? Yeah. Yeah, they added show you guys I'm looking at. They added these strikes down here. So 31 through 38 they added on support. And then dude, the 30, okay, let me look at this 30 strike. $200 to $1,600. So here's the chart for the support 30 strike call. Look at how long. Okay, hold on. Let me actually zoom this thing out. This thing, see, this thing actually had value even back here. Wait, why is it not giving me more days? This is a new one also, isn't it? They added this one. I gotta go back down like 10. SPY dropping. Oh, it's prepared statements out. He's talking. It might be appropriate to begin tapering this year. So the 11 strike. Look at the 11 strike on here. On support. Oh, look at the SPY, just volatile with the statement out. Now they're just all the analysts and stuff are just siphoning through that the written statement, and they're reacting on the SPY, as you see, just getting it volatile. All right, here it goes. Let's see. The audio fixed. Do that. Do that. Do this. Ooh, how about that for jazz? It's kind of poppy jazz. It's okay, it's okay. Is this even the right
Hello,
screen?
I'm Esther George, President of the Federal Reserve Bank of Kansas City. In late August each year since 1982, the Kansas City Fed has been honored to welcome central bankers, policymakers, academics, and others.
Don't forget to thumbs up, subscribe if you haven't. We're going to cruise through this. If you have any comments, feel free to leave them in chat.
After hosting a virtual conference last year, it was
inform
our
us
hope
what we're
that
hearing,
we could convene in person this week. And that seemed a reasonable plan before local health conditions changed. I regret the inconvenience of this last-minute pivot to a virtual format.
Their audio quality sucks, sorry.
At the Jackson Lake Lodge and many others in the Jackson Hole area for working with us for months to make preparations and accommodations. So virtually, we will open the program today.
Look at that SPY rip, man.
Fed Chairman Jay Powell.
So this is ripping based on reactions that they're just seeing on his written statement, I'm sure, because clearly he hasn't been talking yet. So the first however many minutes, he's just going to be basically reading his prepared statement. And then what's unknown will be, I think they'll probably have questions or something, and that's where it's kind of off the cuff and where you get more crazy stuff. But they apparently, they apparently like what he's saying. He's probably more dovish. I don't even know all the animals. Look at that freaking bar. That candle. Oh my.
17 months have passed since the U.S. economy faced the full force of the COVID-19 pandemic. This shock led to an immediate and unprecedented decline, as large parts of the economy were shuttered to contain the spread of the disease. The path of recovery has been a difficult one, and a good place to begin is by thanking those on the front line fighting the pandemic. The essential workers who kept the economy going, those who have cared for others in need, and those in medical research, business, and government who came together to discover, produce, and widely distribute effective vaccines in record time. We should also keep in our thoughts those who have lost their lives from COVID, as well as their loved ones. Strong policy support has fueled a vigorous but uneven recovery, one that is, in many respects, historically anomalous. In a reversal of typical patterns in a downturn, aggregate personal income rose rather than fell, and households massively shifted their spending from services to manufactured goods. Booming demand for goods and the strength and speed of the reopening have led to shortages and bottlenecks, leaving the COVID-constrained supply side unable to keep up. The result has been elevated inflation in durable goods, a sector that has experienced an annual inflation rate well below zero over the past quarter century. Labor market conditions are improving but turbulent, and the pandemic continues to threaten not only health and life, but also economic activity. Many other advanced economies are experiencing similarly unusual conditions. In my comments today, I will focus on the Fed's efforts to promote our maximum employment and price stability goals amid this upheaval, and suggest how lessons from history and a careful focus on incoming data and the evolving risks offer useful guidance for today's unique monetary policy challenges. The pandemic recession, the briefest yet deepest on record, displaced roughly 30 million workers in the space of 2 months. The decline in output in the second quarter of 2020 was twice the full decline during the Great Recession. But the pace of the recovery has exceeded expectations, with output surpassing its previous peak after only 4 quarters, less than half the time required following the Great Recession. As is typically the case, the recovery in employment has lagged that in output. Nonetheless, employment gains have also come faster than expected. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, despite progress, joblessness continues to fall disproportionately on lower wage workers in the service sector and on African Americans and Hispanics. The unevenness of the recovery can further be seen through the lens of the sectoral shift of spending into goods, particularly durable goods such as appliances, furniture, and cars, and away from services, particularly in-person services in areas such as travel and leisure. As the pandemic struck, restaurant meals fell 45%, air travel 95%, and dentist visits 65%. Even today, with overall GDP and consumption spending more than fully recovered, services spending remains about 7% below trend. Total employment is now 6 million below its February 2020 level, and 5 million of that shortfall is in the still depressed service sector. In contrast, spending on durable goods has boomed since the start of the recovery and is now running about 20% above the pre-pandemic level. With demand outstripping pandemic-afflicted supply, rising durables prices are a principal factor lifting inflation well above our 2% objective. Given the ongoing upheaval in the economy, some strains and surprises are inevitable. The job of monetary policy is to promote maximum employment and price stability as the economy works through this challenging period. I'll turn now to a discussion of progress toward those goals. The outlook for the labor market has brightened considerably in recent months. After faltering last winter, job gains have risen steadily over the course of this year and now average 832,000 over the past 3 months, of which almost 800,000 have been in services. The pace of total hiring is faster than at any time in the recorded data before the pandemic. The levels of job openings and quits are at record highs, and employers report that they cannot fill jobs fast enough to meet returning demand. These favorable conditions for job seekers should help the economy cover the considerable remaining ground to reach maximum employment. The unemployment rate has declined to 5.4%, a post-pandemic low, but is still much too high, and the reported rate understates the amount of labor market slack. Long-term unemployment remains elevated, and the recovery in labor force participation has lagged well behind the rest of the labor market, as it has in past recoveries. With vaccinations rising, schools reopening, and enhanced unemployment benefits ending, some factors that may be holding back job seekers are likely fading. While the Delta variant presents a near-term risk, the prospects are good for continued progress toward maximum employment. The rapid reopening of the economy has brought a sharp run-up in inflation. Over the 12 months through July, measures of headline and core PCE inflation have run at 4.2% and 3.6% respectively, well above our 2% longer run objective. Businesses and consumers widely report upward pressure on prices and wages. Inflation at these levels is, of course, a cause for concern. But that concern is tempered by a number of factors that suggest that these elevated readings are likely to prove temporary. This assessment is a critical and ongoing one, and we are carefully monitoring incoming data. The dynamics of inflation are complex, and we assess the inflation outlook from a number of different perspectives, as I will now discuss. The spike in inflation is so far largely the product of a relatively narrow group of goods and services that have been directly affected by the pandemic and the reopening of the economy. Durable goods alone contributed about 1% to the latest 12-month measures of headline and core inflation. Energy prices, which rebounded with the strong recovery, added another 0.8% to headline inflation. And from long experience, we expect the inflation effects of these increases to be transitory. In addition, some prices, for example, for hotel rooms and airplane tickets, declined sharply during the recession and have now moved back up close to pre-pandemic levels. The 12-month window we use in computing inflation now captures the rebound in prices, but not the initial decline, temporarily elevating reported inflation. These effects, which are adding a few tenths to measured inflation, should wash out over time. We consult a range of measures meant to capture whether price increases for particular items are spilling over into broad-based inflation. These include trimmed mean measures and measures excluding durables and computed from just before the pandemic. These measures generally show inflation at or close to our 2% longer-run objective. We would be concerned at signs that inflationary pressures were spreading more broadly through the economy. We are also directly monitoring the prices of particular goods and services most affected by the pandemic and the reopening, and are beginning to see a moderation in some cases as shortages ease. Used car prices, for example, appear to have stabilized. Indeed, some price indicators are beginning to fall. If that continues, as many analysts predict, then used car prices will soon be pulling measured inflation down, as they did for much of the past decade. This same dynamic of upward inflation pressure dissipating and in some cases reversing seems likely to play out in durables more generally. Over the 25 years preceding the pandemic, durables prices actually declined, with inflation averaging negative 1.9% per year. As supply problems have begun to resolve, inflation in durable goods other than autos has now slowed and may be starting to fall. It seems unlikely that durables inflation will continue to contribute importantly over time to overall inflation. We will be looking for evidence that supports or undercuts that expectation. We also assess whether wage increases are consistent with our 2% inflation goal over time. Wage increases are essential to support a rising standard of living and are generally, of course, a welcome development. But if wage increases were to move materially and persistently above the levels of productivity gains and inflation, businesses would likely pass those increases on to customers, a process that could become the sort of wage price spiral seen at times in the past. Today, we see little evidence of wage increases that might threaten excessive inflation. Broad-based measures of wages that adjust for compositional changes in the labor force, such as the Employment Cost Index and the Atlanta Wage Growth Tracker, show wages moving up at a pace that appears consistent with our longer-term inflation objective.
Wonder when he's going to show the yield curve flattening chart, or the overbought S&P for since 2008 quantitative easing. Is that coming?
Policy can and should look through temporary swings in inflation. Our monetary policy framework emphasizes that anchoring longer-term expectations at 2% is important for both maximum employment and price stability. We carefully monitor a wide range of indicators of longer-term inflation expectations. These measures today are at levels broadly consistent with our 2% objective. Because measures of inflation expectations are individually noisy, we also focus on common patterns across the measures. One approach to summarizing these patterns is the board staff's Index of Common Inflation Expectations, which combines information from a broad range of survey and market-based measures. This index captures a general move down in expectations starting around 2014, a time when inflation was running persistently below 2%. More recently, the index shows a welcome reversal of that decline and is now at levels more consistent with our 2% objective. Longer-term inflation expectations have moved much less than actual inflation or near-term expectations, suggesting that households, businesses, and market participants also believe that current high inflation readings are likely to prove transitory and that in any case, the Fed will keep inflation close to our 2% objective over time. Finally, it is worth noting that since the 1990s, inflation in many advanced economies has run somewhat below 2%, even in good times. The pattern of low inflation likely reflects sustained disinflationary forces, including technology, globalization, and perhaps demographic factors, as well as a stronger and more successful commitment by central banks to maintain price stability. In the United States, unemployment ran below 4% for about 2 years before the pandemic, while inflation ran at or below 2%. Wages did move up across the income spectrum, a welcome development, but not by enough to lift price inflation consistently to 2%. While the underlying global disinflationary factors are likely to evolve over time, there is little reason to think that they have suddenly reversed or abated. It seems more likely that they will continue to weigh on inflation as the pandemic passes into history. We will continue to monitor incoming inflation data against each of these assessments. To sum up, the baseline outlook is for continued progress toward maximum employment, with inflation returning to levels consistent with our goal of inflation averaging 2% over time. Let me now turn to how the baseline outlook and the associated risks and uncertainties figure in our monetary policy making. The period from 1950 through the early 1980s provides two important lessons for managing the risks and uncertainties we face today. The early days of stabilization policy in the 1950s taught monetary policymakers not to attempt to offset what are likely to be temporary fluctuations in inflation. Indeed, responding may do more harm than good, particularly in an era where policy rates are much closer to the effective lower bound even in good times. The main influence of monetary policy on inflation can come after a lag of a year or more. If a central bank tightens policy in response to factors that turn out to be temporary, the main policy effects are likely to arrive after the need has passed. The ill-timed policy move unnecessarily slows hiring and other economic activity and pushes inflation lower than desired. Today, with substantial slack remaining in the labor market and the pandemic continuing, such a mistake could be particularly harmful. We know that extended periods of unemployment can mean lasting harm to workers and to the productive capacity of the economy. History also teaches, however, that central banks cannot take for granted that inflation due to transitory factors will fade. The 1970s saw two periods in which there were large increases in energy and food prices, raising headline inflation for a time. But when the direct effects on headline inflation eased, core inflation continued to run persistently higher than before. One likely contributing factor was that the public had come to generally expect higher inflation, one reason why we now monitor inflation expectations so carefully. Central banks have always faced the problem of distinguishing transitory inflation spikes from more troublesome developments, and it is sometimes difficult to do so with confidence in real time. At such times, there is no substitute for a careful focus on incoming data and evolving risks. If sustained higher inflation were to become a serious concern, the FOMC would certainly respond and use our tools to assure that inflation runs at levels that are consistent with our goal. Incoming data should provide more evidence that some of the supply-demand imbalances are improving, and more evidence of a continued moderation in inflation, particularly in goods and service prices that have been most affected by the pandemic. We also expect to see continued strong job creation, and we'll be learning more about the Delta variant's effects. For now, I believe that policy is well positioned, As always, we are prepared to adjust policy as appropriate to achieve our goals. That brings me to a concluding word on the path ahead for monetary policy. The committee remains steadfast in our oft-expressed commitment to support the economy for as long as is needed to achieve a full recovery. The changes we made last year to our monetary policy framework are well suited to address today's challenges. We have said that we would continue our asset purchases at the current pace until we see substantial further progress toward our maximum employment and price stability goals, measured since last December when we first articulated this guidance. My view is that the substantial further progress test has been met for inflation. There has also been clear progress toward maximum employment. At the FOMC's recent July meeting, I was of the view, as were most participants, that if the economy evolved broadly as anticipated, it could be appropriate to start reducing the pace of asset purchases this year. The intervening month has brought more progress in the form of a strong employment report for July, but also the further spread of the Delta variant. We will be carefully assessing incoming data and the evolving risks. Even after our asset purchases end, our elevated holdings of longer-term securities will continue to support accommodative financial conditions. The timing and pace of the coming reduction in asset purchases will not be intended to carry a direct signal regarding the timing of interest rate liftoff, for which we have articulated a different and substantially more stringent test. We have said that we will continue to hold the target range for the federal funds rate at its current level until the economy reaches conditions consistent with maximum employment and inflation has reached 2% and is on track to moderately exceed 2% for some time. We have much ground to cover to reach maximum employment, and time will tell whether we have reached 2% inflation on a sustainable basis. These are challenging times for the public we serve, as the pandemic and its unprecedented toll on health and economic activity linger. But I will end on a positive note. Before the pandemic, we all saw the extraordinary benefits that a strong labor market can deliver to our society. Despite today's challenges, the economy is on a path to just such a labor market, with high levels of employment and participation, broadly shared wage gains, and inflation running close to our price stability goal. Thank you very much.
Figured there'd be some questions or something. Is that it? If that's it, then we could have just read it. We need to hear him come talk about it. You guys have another link to... Yeah, that was it. Doctor. That was it. Well, indeed. I'm sure there's more going on at Jackson Hole Symposium. I don't have any other links. Do you guys have any other links? I don't know. I'm surprised he's not having questions or anything like that. I guess it's not like a Fed Minutes recording of it. Yeah. Yeah, that's it. Well, the market liked it, I guess, because it wasn't awful, which is oh so common when he speaks. They just like to go to Jackson Hole and go mountain biking. A bunch of the people that control our financial system every year in the summer. Oh, Baba puts up. Baba's dropping. Yeah, that, I mean, I've seen that so many times with Powell. The market, I mean, this was probably Afghanistan, but the market will kind of anticipate him coming on, and you'll see low volume, and it might just kind of be steady. It might not necessarily be dropping, but then when he talks, it's like it's not good or bad. It's just the market rallies because it wasn't the world's gonna end, so everyone's pretty pumped. But I think I mean, the market still could kind of have a continuation reaction from yesterday. Uh, we've seen that happen, and I was kind of expecting them to push off if we do start to go bearish on the SPY until next week. Um, yeah, Powell always is that way. I mean, I can only assume I don't know. Did he say he's not going to keep running? He didn't say anything about that, huh? Because he might not. He might resign after his term's up. Um, Too much pressure. But yeah, I think the SPY. I don't know. This could be the last little blow off the top, just like we had here, just like we had here, just like we've had so many times. But I don't know. I don't know. That's crazy. KYC Fed page. Yeah, come at it. Oh, the minute was made. You send me to rubber. Yes, everything will be fine. Oh man, I was hoping for something, but nothing happened. I don't know why my screen is all stretched. So Astra's got their launch today. I wanted to actually live stream that. When is that? Let me see. Astra. Where's it launching from? Opens August 27th. Oh, I don't even know yet. Okay, well, yeah, GME looks good. It's got a nice bull flag going here. Again, we might retest this support a little bit. Down here like 195, just because it's MACD, but not necessarily either, just because the price action is so nice. So nice and steady up here. Might be another day of consolidating. I mean, this is an epic looking pendant or bull flag or whatever you call that going into next week. And then, yeah, then we'll have Monday, Tuesday, and then Wednesday, what margin requirements go up significantly. So I'd say probably what the smaller hedgies are going to have to cover or something. Yeah, probably. Well, my puts are done. I didn't have a whole lot. I had a small amount. Meanwhile, support. Dang, this thing's holding up well. Very well. Yeah, I mean, I don't even know what the short interest was. I mean, I guess no one really does, but it couldn't have been even close to GameStop's. And look how much this thing's gone up. You know what I mean? Like, what, 30%, 50%? I wonder if it would have been more of a violent move if the options had closer strikes, causing more gamma squeezes. But yeah, just back here was $3. That was quite a while ago, I guess. Had a nice consolidation there for a long time, and then that gap up is insane. That happened to GameStop back in January. We had 100% gap up. Yeah. I mean, SPY's still bullish. It did yesterday just barely go bearish on the MACD on the daily, but all the price action was above the 9. Still following this trend line to the outer atmosphere, as one of you pointed out. That's literally what it's done since COVID. And then if you want to look back at 2008, quantitative easing, yep, that's when we just kind of went off track. I think lost the rails. Didn't fully correct in 2008 like we probably should have, and tampered it, and now it's going to be bigger. Man, Let's see how my play's doing. Astra's doing nice things. Probably, I kind of want to get out of some of these before. I should probably before the rocket launches. Just because I mean, it could go crazy though. Kind of a big amount, 519. Then this put credit spread. Let's see, 12.5. It's got to stay above. But that's just I'd probably just come up on that just from time decay, because it's not. I mean, it's still in the money. Yeah, I've got this in the long term too. What else is moving on the account? Rocket's down. I've got a covered, or no, I've got a naked short put on this, 1750. So kind of fine if it gets exercised though. I was down to pick up some more shares. My average cost on Rocket's awful. It's like $28. I got in it after the first earnings, or before. I was like, oh, this is a rocket company. It's gonna be great. I know better than to get in before earnings. I got in like here, earnings, and I liked it, so I held it, which is fine. Had options, came up here, and then had options that were actually covered this time, and this was insane. This pumping up one day up, next day down. I just held through it for most of my options. I took some profits, but that was a huge move for me. At that point, that was like, I mean, those options were worthless. It was like $400 and like 14,000, and I think I only pulled away like $5,000 from it. I just didn't imagine it doing just that. This is why I actually think Rocket's probably going to go again at some point, because this was right along the same line, same time. This and Corsair. This is February 25th. Yeah, right here. That's when GameStop went. And I think, yeah, this is when he offered a dividend too. The Rocket CEO, that dude has he hates shorters, and he is out to get rid of them. So he offered a dividend, and it squeezed him that one day, but they just piled on a way bigger short position at the top there and brought it back down. Corsair also had that same deal. 614, what was that? Oh, that was a weird little pump. Maybe that was earnings? It could have been earnings. No, it's not earnings. That's strange. I thought it rallied when Rocket did. There's a January. Yeah, that January had a big candle. That's strange. Okay, guys. I guess that'll do it for me. Sub up, like up, comment down. Happy money sticks around. Thanks for joining. Probably won't do the Rocket stream. I don't know a whole lot about Astra, and I know enough to want to be in it, but I was kind of hoping Pal was going to have questions and stuff, or I probably wouldn't even stream this. Probably just stream the Fed Minutes next time, where he answers questions and does a great job of skirting everything. Oh man. All right, guys. Well, thanks for watching. Follow us on Twitter. Jump on our Discord if you haven't. Billy the Kid appeared. Peace out.